What's poppin', everybody? You already know what time it is. My name is Imposer Power, the man, the true money man, because money matters the most. I'd like to welcome you to our YouTube channel once again called FeudVest Tech. FeudVest Tech is a financial literacy YouTube channel that focuses on promoting and providing proper money management skills. So in today's chat, we will be having a look at investment or investing 101, where we will be defining investing, how you can start investing, and what is investing really all about. So without further ado, welcome back if it's not your first time joining, and a very warm welcome if it's your first time tuning into our channel. And without any further ado, let's just go into today's topic. So what is investing? Investing is the process of buying assets that increase in value over time with the expectation of generating or achieving a profit. However, in the grand scheme of things, investing can also be defined as spending time or money on helping better or upskill yourself. So let's say, for instance, you're not quite good with computers and you'd like to learn more about computers. You can take a short course on computer literacy and you can pay for it, which will ultimately and eventually help you become better with your computer literacy skill. So investing is not necessarily just involved with buying assets at a low price and selling at a higher price, or buying assets with the expectation of achieving profits in the long term. Investing is a broad definition that can be applied into different aspects of your life, right? So how does investing work? So in the simplest process, investing is buying assets at a low price and selling it at the higher price with the expectation of obviously generating a profit from that investment, right? So it's really not as easy as it sounds when people say you buy assets low and selling it at the higher price, right? It takes a lot of time and research and understanding of how to buy assets when they're low and selling them when they're high. So now that we do have that definition out of the way, we can also explain how to generate income out of investing. So the first would be called capital gains, where you buy assets at a low price and sell it at the higher price. So that's capital gains, right? And then we also have what we call dividends. So dividends is essentially when you buy, let's say for example, a company that is listed on the JSE, and when that company pays out contributions or distributions to shareholders, as a shareholder you would get a piece or portion of the company profits when the company report their earnings. And just to keep in mind that not all companies pay out dividends, so this would be predominantly dependent on the company dividend policy, where some companies do pay out dividends maybe twice a year or maybe once a year. However, it depends from company to company in terms of paying dividends. So now that we have that out of the way, we will be talking about what are the types of investments that you can invest in. So in this chat, I'll just be focusing on the basic top 5 investment types. So the first one, we have what we call cash. So cash would be, or would rather include, your everyday bank account, where you will be putting your cash away, getting an interest at a specific interest rate level, right? You are also looking into fixed term deposit accounts, where you deposit money for, let's say for example, 6 months to 12 months. You will be guaranteed a certain interest on your initial investment. So cash would sort of like be considered a low risk investment where you getting interest regularly and your money is not exposed to high risk or market volatility. Then the second option would be fixed interest. This would include investments such as bonds, like government bonds, corporate bonds, where you would essentially be getting paid. It can also be called bond coupons, where on a regular basis, depending obviously on the structure of the bond, you would be getting paid an interest as well as a bond coupon or monthly payments or quarterly payments, depending obviously on the structure of that fixed interest. Thirdly, we have what we call as shares or equities. These are considered growth and high risk investments, and essentially here you will be investing for the long term, and obviously with market volatility basically means that the price of that particular financial product or instrument is exposed to prices fluctuating on a daily prices, and the prices really are not predictable. No one can really predict where a share price would go from where it's currently at. So the price could go up, the price could go down. That is the risk part when it comes to investing in shares, right? So shares would generally be an investment vehicle for the long term. We would consider long-term investments for, let's say, about 5 to 10 years. That would help you ride out all the ups and downs, because markets and share trading do happen every day, where you have investors and traders across the world trading, buying and selling shares. So that would expose your capital from increasing in value as well as decreasing in value. Again, share prices are exposed to a lot of volatility, high risk investments. Be very careful when you buy shares. This is considered one of the greatest, arguably, investment case, where your investment can literally go as much as it can, or can actually gain value as much as it can, as well as lose value as much as possible, and even lose value to the point where it goes below your initial investment amount. Be very cautious when it comes to investing in shares, as these expose you to high risk. So within shares, you can buy single companies. So you have companies, just an example, you have companies that are listed on the JSE, such as, let's say, BHP, Billiton, Naspers, the Purple Group. We have Discovery, we have financial services, we have banks, we have mineral resources. So there's a lot of companies that you can find from the JSE, which are single shares. You can also find what we call ETFs. So with ETFs, you're looking at a basket of shares. You will also have funds that are managed by fund managers, which are normally called managed funds. We also have unit trusts. That is also like a fund that is also managed by fund managers. We will delve into ETFs, unit trusts, single shares in other episodes, but for now we just want to get the basic types of investments out of the way, right? So remember that shares are very risky and expose you to a lot of market risk. And then we also have property, right? So property, this includes housing, this include investing in, a brick and mortar property. So you can also invest in property. You have different variety of options when it comes to property investing. You can invest in REITs, real estate investment trusts, which are actually available on the stock exchange, or you can actually invest directly in property, right? Which we will also talk about in detail in the upcoming videos, right? So property is also considered another type of investment. And then lastly, we have commodities. Commodities essentially would include natural resources such as gold, platinum, silver, agricultural products, etc. So normally people would be like, how would I invest in oil? Because oil eventually people think that you need to buy physical oil to invest in oil. So now we do have available products on the exchange such as ETFs as well as ETNs, which provides you access to actually invest in commodities. You have gold ETFs, you have oil ETFs, copper ETFs, instead of directly buying physical gold or physical copper with the sake of investing in such investment types. So just to recap, we have 5 investment types. We have cash, we have fixed deposits or bonds, we also have shares, we have property, and then we also have commodities, right? These would be sort of like the basics of investment products one would consider when starting off your investment journey, right? And I just also wanted to emphasize the point of risk and diversification. So every investment incurs or has risk associated with it. So essentially, you can lose all of your money if the investment that you invested in goes the opposite direction compared to the likelihood of generating an income in the long run. So investment, I need to emphasize the point that investment also has high risk. However, there are different levels of risk associated with investing. We have high risk products such as shares, for example, because that exposure to the everyday buying and selling of shares. And then you also have low risk investment products such as bonds or fixed interest or cash as well, where you'll be just getting a guaranteed amount of interest based on the structure of that investment product. So risk is also another factor that you need to factor in when it comes to understanding the basics of investment. And then lastly, to sum it up, I'd like to highlight the fact that diversification also helps you reduce your risk. So diversification basically means spreading your risk across different asset classes or spreading your risk into different investment products. So an example of diversification would be investing in ETFs. So an ETF is a great example of diversification. So an ETF is an exchange traded fund, which is sort of like a basket of shares. You have, let's say, 10 or 20 companies in one basket, which is different companies operating in different sectors, which will provide you less risk compared to just buying one share, which exposes you to a lot of risk. So example, you buy the JSE Top 40 or the Satrix 40, which has the top 40 biggest companies in that index. So within that top 40 biggest companies, you would find that regardless of how the economy is performing, the weight, not the weighting, but rather the basket or the risk would be flattened out because you're not only exposed to telecommunications. If let's say there's a bit of regulatory uncertainty when it comes to ICASA, so that would expose the telecom sector to a lot of risk. Or let's say there's risk in mining, in the mining sectors, where commodity prices are at low prices, where people will not be looking into investing a lot into commodities. They would be maybe looking into financial. So if you have different companies and different sectors within your share portfolio or your investment, it would help you reduce your risk through diversification, if that makes sense, right? So I think that's it for today. So better keep in mind that investment exposes you to risk. Do your research as much as you possibly can, and if you want to know about how to start investing, we would be sharing that video shortly about which maybe investment, or rather, let me just put a disclaimer for you guys. Any information that is provided herein shouldn't be contained or taken as financial advice. This is just for educational purposes and help you get an understanding of how the world of investing works, right? So I'm glad that I was able to share with you this content, and I hope it was very helpful and that you have taken something out of this. And if you have any questions, feel free to drop your questions or concerns or suggestions in the questions or comment sections. If you have anything that you'd like us to share in the next video, feel free to pop us that message, and then we will be glad to help you out. Don't forget, guys, make sure that you subscribe, you like, switch on that notification bell to get notified whenever we release a video. And that's it from me, Mpozo Power, the man, money man, because money matters the most. Thank you so much for your time, guys. Have a great one. Cheers, bye.